Greetings. My name is Kyle Soley. I'm a partner here at Reed Smith, and with me today is Sebastian Watt, who's also a lawyer at Reed Smith. For those of you who don't know, Reed Smith is a global law firm with the largest state tax practice in the country of about 40 lawyers exclusively practicing in state tax. What we're here to talk about today is tax reform, but this is not yet another of the same state tax reform videos. We're going to be focusing on the transition tax 965, but in particular we're going to be focusing on its impact on state NOLs. And three states in particular, New York, Florida, and New Jersey. Those three states we have found have problems where the transition tax is diminishing the amount of our clients' NOLs. And we think that the diminishment of those NOLs violates the principles under the U.S. Supreme Court's decision in Kraft. So really this video is for you if one, your company is doing business in Florida, New York, and New Jersey. Two, if you had income inclusion under Section 965, and three, if that income inclusion diminished the amount of your net operating losses. So we encourage you to go back to the office, or if you're in your office, to run some scenarios to see what it would look like if you included and then excluded the 965 income, whether that would impact the amount of your net operating losses. And if it does, using the what we describe in this video, you may be able to restore some of those net operating losses. So there's three states that Sebastian and I have looked at, again, New York, Florida, and New Jersey. Today we're going to be talking about focusing on New York. So with that, I'll turn it over to Sebastian to give us a technical walkthrough.
Thanks, Kyle. So most taxpayers believe that New York doesn't tax 965 income. And while that's generally true, there are some situations in which New York can reduce or eliminate your net operating loss carryforward, or your business loss carryforward from the year of your 965 inclusion to future years, thereby increasing your tax in future years. So we're going to walk through what causes that problem and why we think some taxpayers in some situations do not need to reduce or eliminate their NOL in the year of the 965 inclusion. So let's start with the basics. Why is 965 included in the New York base to begin with? When New York conforms to federal taxable income, the New York starting point for its corporate tax base is federal taxable income, therefore 965 is in the base. New York also provides for a subtraction for 965 income, but in some situations that subtraction is not complete, thereby reducing or eliminating your business loss, your net operating loss carry forward. Let's talk through the mechanics. In New York, your business income or your business loss that we're focusing on is your entire net income. That includes your 965 income minus other exempt income and investment income. Let's put investment income to the side. We're just going to focus on other exempt income. That's your deduction for 965. The problem is that deduction for other exempt income is limited by this rule. Other exempt income cannot exceed entire net income. What that means is if your 965 income or your deduction for other exempt income is greater than your entire net income, your business loss for the year, your net operating loss, is going to be limited. So why is that a problem? Well, in short, 965 is a deemed dividend from foreign subsidiaries only. So the interaction between 965 and New York law creates a situation where New York is treating a taxpayer who invests in a foreign subsidiary worse than the same taxpayer that invests in a domestic subsidiary. It's a lot of words, so let's walk through some examples. In our first example, let's take a New York taxpayer, USP, who's an investment in a US subsidiary. Let's assume this is before 2015, before New York required all taxpayers to file combined returns. USP has a loss of $100, and its US subsidiary has $200 of income. So here's our computation. Business loss equals entire net income minus other exempt income. And we're assuming here that again, USP, the situation is before 2015, before New York went mandatory combined, and there's no substantial intercompany transactions between USP and US sub.
So USP is filing a separate return.
That's exactly right. USP is filing a separate return. So let's start with the components of entire net income. USP's loss before including any income from the subsidiary is $100. As we said, there is no mechanism by which New York would include the U.S. subsidiary's income in USP's entire net income. Therefore, USP's entire net income is still a $100 loss. No other exempt income to remove from the base, so the business loss is $100.
So even though, so Sebastian, so I'm getting this, so even though USP owns a subsidiary that has income, that income is disregarded and USP gets to keep its $100 loss.
Exactly right. Now that's going to change in a second. Let's run the same scenario, but the only factor we're going to change is USP invests in a foreign subsidiary rather than a U.S. subsidiary.
And just to make sure I understand the timing of this, are we assuming that this foreign subsidiary is earning the earnings in the same year that the domestic subsidiary we just looked at earned those earnings?
That's exactly right. Let's assume these are foreign earnings earned before 2015, let's say, from 1987 to 2015. IRC 965 comes along and says that USP now has to include this $200 of 965 income in its entire net income, in its New York tax base. At see how this plays out. Again, here's our rule. Business loss equals entire net income minus other exempt income. Let's look at the components of entire net income. USP's loss before subsidiary income is $100, just like last time. But this time, the subsidiary's income is included in USP's entire net income, so we have $200 of subsidiary income. USP's entire net income, therefore, is $100, the net of the $100 lost and the $200 of 965 income. Now, what you would want is for New York subtraction for 965 income to be the full $200. You want it to, if it goes in, you want it all to come out. The problem here is this rule that we have. Other exempt income cannot exceed entire net income. New York's deduction for 965, this other exempt income deduction, is limited to $100 in this scenario. And what that means is that USP's business loss in this situation is $0. Let's compare that with our prior example. In our first example, we had USP, a New York taxpayer, investing in a US subsidiary. Its business loss was $100. The only thing we changed was that the US parent, this New York taxpayer, invested in a foreign subsidiary. Its $100 is wiped out in that year. Again, this problem is caused by this rule: other exempt income cannot exceed entire net income. Now this results in unequal treatment. That unequal treatment is similar to the problem Kyle mentioned at the beginning in the Supreme Court's decision in Kraft versus Iowa. Iowa allowed a deduction for dividends from U.S. subsidiaries but not domestic subsidiaries. The U.S. Supreme Court said that runs afoul of the Foreign Commerce Clause, and to remedy that constitutional violation, Kraft was entitled to take a dividends received deduction for foreign dividends just like it would have for domestic dividends. So applying Kraft to this New York problem, a New York taxpayer with 965 income shouldn't be required to reduce its current year business loss that it can carry forward into future years and offset future income solely because it chose to invest in a foreign subsidiary rather than a domestic subsidiary. A taxpayer can remedy the problem by simply not limiting its other exempt income deduction to entire net income. Take the full $200. You have $200.95 coming in, take it out. In this case, the business loss, your business loss is going to be what it would have been without 965. And constitutionally, doing that resolves what was previously unequal treatment and equalizes the treatment between a taxpayer with an investment in a U.S. subsidiary and a foreign subsidiary.
And just to be clear, this problem, in other words, if somebody's listening to this and they're saying, yeah, I've got a foreign subsidiary and it has earnings and profits, and those earnings and profits are included under 965, so my NOL is being diminished just like your example shows. They don't have to have a comparable U.S. subsidiary. We're just establishing that U.S. subsidiary as a hypothetical benchmark to say, if your foreign subsidiary had been domestic, it wouldn't have been mistreated, and therefore your foreign subsidiary gets to be treated as if it were domestic, essentially, and not have that inclusion that diminishes the NOL. Is that a fair way of putting it?
That's exactly right. Yes, if your 965 is causing this limitation to be triggered, you potentially have this problem and can potentially apply the solution that we're proposing here.
Well, Sebastian, thank you for that technical walkthrough. Feel free to contact either Sebastian or I if you have any questions about this. And also tune in. We have 2 other videos that have similar problems. One video that covers a problem like this in Florida, where the 965 inclusion diminishes net operating losses, and another video that involves New Jersey, where a similar thing happens. Thanks again, and we hope to see you in another video.